Budget after budget after budget, you'd be forgiven for losing track of the UK government's financial policy so far this year. But as an investing channel, I'm going to break down the 2 key tax changes that you need to know to make sure that you're well prepared for the future. These key changes are going to make ISAs and tax advantaged accounts so much more important to invest through. So watch this space. Oh, and before we get started, if you do find anything in this video useful, please do drop a like on the video and consider subscribing to the channel if you haven't done so already. In the UK, and specifically for stock market investing, there are 2 main taxes that you'll be faced with, and those are capital gains tax and dividend tax. Capital gains tax is paid on any growth that you've seen in an investment position at the point at which you sell. For example, if you invested in 100 shares of Shell back when the price was £10 per share, you'd have spent £1,000 on that investment. If you then sold that position when the shares are valued at £25 per share, you would have sold for a total value of £2,500. The £2,500 end value minus the £1,000 that was initially invested will give you a capital gains of £1,500. It's key to remember here that you don't pay capital gains tax on any investments where you haven't yet sold out of the position. So unrealised gain or losses are not subject to this tax. In the 22-23 tax year, you get £12,300 of capital gains allowance. But once you're outside that threshold, the government get their taste of the pie. Capital gains tax is paid at 10% for anybody who is a basic rate taxpayer. So that's anybody out there who's earning under £50,270 per year. If you're a higher rate taxpayer, so anybody earning over £50,270, you'll pay capital gains tax at 20% rather than 10%. Now, if that isn't enough to navigate, there's of course also dividend tax. A dividend is a payment that you receive into your portfolio either monthly, quarterly, biannually, annually, or kind of as an ad hoc, which is usually part of a company's profits, which is paid out to the investors into that company. You can also receive dividends for holding some index funds, ETFs, and other things like life strategy funds. Like capital gains, there's also a dividend tax allowance, and in the 22-23 tax year, you can earn up to £2,000 of dividends before you have to pay any tax on them at all, which is a really nice way to get consistent income into your portfolio. Above that threshold though, a basic rate taxpayer will pay 8.75% on any dividends over £2,000, with a higher rate taxpayer having to fork out 33.75% dividend tax on anything earned over £2,000. For investments, we in the UK can consider ourselves fairly fortunate because we've got access to a product known as an individual savings account, or ISA, which essentially is a completely tax-free wrapper. This means that you can invest in the stock market consistently over many years, and no matter what the value of your end portfolio is, it is completely safe from both capital gains and dividend tax. The only caveat to that is that you can only invest £20,000 into an ISA within a tax year, but that's still more than enough allowance to allow you to create a portfolio which you can invest in to secure your own financial future. And the use of this tool has just become even more important, with Jeremy Hunt announcing changes to both capital gains tax and dividend tax for 2023-2024 and 2024-2025 and beyond. So you really need to be using an ISA now, and this is why. The old tax-free thresholds in terms of capital gains and dividend tax used to be a long way off for anyone who was starting out investing. £2,000 was a substantial amount of dividends to be generating in a year, and of course £12,300 in capital gains is again something that happens over a number of years. But with the changes that I'll discuss now, all of this could change. While the actual percentage rate of tax will stay unchanged, the tax-free allowance has been reduced substantially by up to 75% in some cases. Capital gains allowance will be reduced from £12,300 in this tax year to just £6,000 in 22-23, and then down to just £3,000 in 23-24. For dividend tax, the tax-free allowance currently sits at £2,000, and that will be slashed by 50% to just £1,000 in 23-24, before then cutting a further 50% to just £500 in 24-25. That's 2 consecutive 50% reductions in tax-free allowances. All these numbers might not really mean anything to you, and you might be sat there thinking, well, I only make about £100 in dividend income per year, and I've only generated £600 in capital gains, and that's all well and good for now. But consider the fact that you could be continuing to invest for 25, 30, 35 or 40 40 years. And perhaps people are already in that situation where they're going to be making a substantial amount in dividend income every single year and will likely have well over £12,300 of capital gains tax, let alone £6,000 and £3,000 when that gets pulled down. For example, if you are a basic rate taxpayer in this financial year and you were selling investments that netted you a capital gains of £20,000, you would currently have to pay capital gains tax on £7,700 of that amount. This would be taxed at 10%, meaning you'd have to pay £770 in capital gains tax after the sale of your investments. Now that doesn't really seem all that bad, but we'll move on to next year. In 2023-2024, using the same example of £20,000 in capital gains, with the capital gains allowance reducing down to £6,000, you would have to pay capital gains tax on £14,000 worth of that capital gains. While that would still be charged at 10%, it would see a capital gains tax bill falling through your letterbox of £1,400 on the same amount of net income that you would have made in the previous year. Now it's not all doom and gloom, this would still allow you to keep £18,600 of the capital gains, but 20,000 would be a lot better, wouldn't it? Then if we consider moving on to 24-25, when the capital gains tax allowance reduces right down to £3,000, the same £20,000 in capital gains would owe capital gains tax on £17,000 worth of the overall amount. Therefore, in this example, you would owe £1,700 of capital gains tax on the same £20,000 of value. This is just one example, and it will obviously be very different for each individual person. But it does just show the impact that this could have on the amount of money that you get to keep of your invested cash. An old way around this used to be to realise less than £12,300 in capital gains within a certain financial year. But with the tax allowance now reducing down to £6,000 and then £3,000, that's not really going to be viable in the same way that it was previously. The dividend tax increase is a real slap in the face for investors, but more so perhaps for owners of small businesses who usually pay themselves through dividends because it used to work out as more financially viable. Let's say you had an investment portfolio valued at £150,000, which probably isn't too unrealistic for most of us if we stay consistent for 10, 15, 20 years. Now let's assume an annualised dividend income of around 3% of the portfolio value, or £4,500 in yearly dividend income. Using the current £2,000 dividend income allowance, tax would only be due on £2,500 of that £4,500 dividend income. Tax on this would be paid at 8.75%, which would see a dividend tax of £218.75. However, moving into next year, when the dividend allowance drops to just £1,000, you would have to pay dividend tax on £3,500 of your total dividend income. This would equate to £306.25, almost a £100 increase in dividend tax in just 1 year. This will then rise again in 24-25 to around £350 in dividend tax, as the dividend tax allowance drops down a further to just £500. All these changes could greatly impact the ability for you to snowball your investment and reinvest dividend income, and it will in essence affect the overall value of your portfolio at the time of maturity. I'll be really interested to hear your thoughts and comments in the comments section below as to how much you feel this could potentially affect you in the coming years. So what can you do about it? The really good news is that the ISA remains unchanged this financial year moving forwards, and there's been no discussion about reducing the ISA allowance or altering any impact of the tax on it. This means that you can completely forget everything we've discussed so far if you continue to invest through an ISA. Therefore, if you're investing through a general investor account on any platform and you've got an ISA available to you, even if it's going to cost you a small amount, it probably will be worthwhile now actually investing through an ISA instead of sticking with a general investor account, because it will reduce the amount of tax that you pay over time, which is going to be substantially more than the small amount that most investment platforms make you pay for the privilege of an ISA. On this channel, we always discuss how important it is to work towards reducing fees that you pay out of your investment pot and the impact that can have on the end value of your investment. But now with these tax changes, we've also got to be incredibly mindful of how tax is going to impact our portfolios as well. And therefore we need to think strategically and take measures to try to avoid the impact of tax on our accounts. Therefore, the absolute best advice would be to max out your ISA first before investing on any other account type. However, if you do invest in mostly cryptocurrency, This is obviously not going to be possible for you because you can't hold crypto in an ISA. If you're sat there thinking, I haven't opened an ISA yet this year, but you want to get ahead of the tax changes, check out this video next where I break down 3 different ISA options and talk about my decision and why I decided to invest in Vanguard through 23-24. And if you have opened an ISA already, check out this video here which talks about my ISA value and it shows how it's done this year. I'll give you a clue, not too well.